Love it or hate it, sell in May and go away is a Wall Street lower that just refuses to go away. Also known as the Halloween indicator, the adage nowadays refers to owning equities for the 6 consecutive months from November through April and being out of the stock market from May through October. At Coherent, we want to provide some rational and objective answers to the question of selling in May as it really matters to our clients. Does selling in May produce different results than holding all months of the year? If so, is the difference attributable to the market's trend? How would my portfolio have performed if I sat in cash May through October? For this presentation, we abridged our research to the U.S. stock market as represented by the S&P 500 price index for the 65 years from 1951 through 2015. We conducted statistical hypothesis tests to determine if there was a difference between calendar year returns for 2 scenarios: holding all months of the year versus selling to cash for the 6 months from May through October. Our methodology is described in the original article posted on our website. Question 1. Does selling in May produce different results? We note 3 important outcomes from our hypothesis test. Given there is only a 5% probability that the difference would be as large as 2.2%, we can safely reject our no difference hypothesis for the alternate. There is a difference. A portfolio which went to cash during May through October underperformed on average by 2.2% per year compared with holding all months. The Sharpe ratio for the sell in May portfolio is 15% higher, indicating that the portfolio has benefits appertaining to risk-adjusted return. So the answer to our first question is that yes, there is a difference, and that difference is negative, but at a benefit of higher risk-adjusted return. Question 2. Is the difference attributable to the market's trend? Yes, most definitely. Calendar year difference in performance between selling in May and holding all months depends on whether the year is up or down. A box plot helps to visualize this difference. We segregated our data for calendar years in which returns were up, down, and flat. When the market is down, one would expect to lose less by being on the sidelines for half of the year, especially when that half includes June and September, the 2 worst performing months on average. But selling in May also misses 4 positive months. Hence, the portfolio outperformed in down years but underperformed in positive years. Hypothesis testing confirmed our observations from the box plot. During positive years, selling in May underperforms on average by more than 6% per year, but outperforms on average by more than 9% during down years. The chance of these differences being random is virtually 0. Question 3. How would my portfolio have performed if I sat in cash May through October? Not as well. This chart tracks the value of 2 $10,000 equity portfolios, one invested all months and the other in cash from May through October. The black line traces cumulative difference in performance starting 1951. By the end of 2015, the sell in May portfolio is behind by about $400,000. Our sell in May portfolio underperformed sharply during bull markets such as in 1994, 2002, and 2009. Conversely, it outperformed in bear markets such as in 2000 and 2008. This relationship is pronounced on the right side of the chart due to the effects of compounding. The bottom line is this: there is a statistically significant negative difference in calendar year returns between selling in May and holding all months. Selling in May carries a 60% chance of underperforming, but in return for less volatility. Selling in May outperforms in market downtrends, but then it's not really about selling in May anymore. Investing has always depended upon knowing what is the trend now and what is its likelihood of changing in the near term. In my experience, there is one Wall Street saying which truly makes sense: the trend is your friend. At Coherent, we aim to provide you with original analysis and opinion. I encourage you to visit our website for more articles and insight into today's markets, including a full version of this presentation. You can also find us on Facebook, LinkedIn, and Google+. My name is Sargon Zia. I'm a Chartered Financial Analyst and Chief Investment Officer at Coherent Financial Advisors. Thank you for watching.